Hello, and thank you for joining our webcast. My name is Jeff Brown, and today I'll be walking through how to uncover hidden insights with commercial risk scores. Credit managers and risk managers have a difficult task. Their companies are in the business of lending money, granting credit, loans to buy goods and services, lines of credit to optimize and bring flexibility to credit management, as well as to establish payment terms. And of course, it's not profitable if these companies don't pay them back or pay them back continuously late. A credit file, if used properly, can essentially build a moat around your business and help protect your receivable. The key elements that enable this are the commercial risk scores. Commercial risk scores are systematic and predictive and have been modeled based on a large population of industry data. As more data comes into the system, the more accurate these scores become. As you can see from this image, Equifax Canada leverages a robust and comprehensive commercial risk database, which is constantly growing and evolving. Whether it's monitoring the life cycle of a business, receiving updated and unique trade lines, or finding new trade companies to contribute their account receivable information, Equifax has this top of mind. In the commercial world, adjudication is predominantly done manually, with credit and risk managers assessing and reviewing a large amount of information in order to support sometimes gut feel decisions. When understood and leveraged properly, risk scores avoid making decisions in only a rear-view mirror approach and open insights into future possible behavior of the business as well. Simply put, risk scores are unbiased and remove gut feel from the equation. Leaders in credit management understand the value that scores play and use them to profile their existing book of business to help provide understanding to your current business's risk tolerance, and can in turn be used to open or contract risk tolerance based on days sales outstanding measures or complications in your industry. Such indications might be increased write-offs, for example. Most Canadian companies regularly pay their bills and have established good credit histories. These are profitable businesses for lending institutions and the financial industry in general. Unfortunately, the companies that are non-payers cause significant losses for lenders, resulting in increased interest rates for all. Identifying these businesses and mitigating their losses in a timely manner makes the entire lending practice more efficient for the lender and the borrower alike. There are three categories for businesses that do not pay. These three categories have distinctly different behaviors and different credit characteristics. These characteristics that they possess have different impacts on the prediction of non-payment. The first category is fraud. Some businesses do not have any intent of meeting their financial obligations. Fraud is often considered a distinct business risk separate from credit risk, and many companies have fraud departments with investigators and practices to mitigate these specific losses. The second category is businesses that have difficulties in managing their credit. These companies use credit and make payments when they can, but in many cases with extreme difficulty. They miss payments, sometimes consecutively, and often carry large balances on their credit products. Institutions dealing with these businesses often need to put accounts into collection and occasionally need to write off amounts owing. Delinquency scores, such as our commercial delinquency score here at Equifax, assess information within a credit file to try to predict these losses and behavior. The third category concerns those businesses that reach such financial difficulty that they need to file for bankruptcy. While this category looks like a more severe case than the previous one, there does tend to be a different behavior on the part of these businesses. In most cases, when an institution is notified that the customer has filed for bankruptcy, the account that they have is in satisfactory status. A payment has been received in the previous month, and everything seems fine. When companies reach a serious financial condition where they lose the ability to pay for their bills, it's common that they will make similar payments or smaller payments on their credit, keeping them in good status so that they can still be used. However, further use and increases of balance and future credit are required. They tap into their line of credit to ensure that they can make their loan payments. They make use of their credit line to pay their credit cards for only a few months. Eventually, they max out their credit cards, lines of credit. They apply for additional credit, new credit cards, as well as loans to pay off what they already owe, all while making payments as long as they can. When the spiral of debt reaches past the point they can sustain, they file for bankruptcy. The Equifax score, called the Business Failure Risk Score, assesses the likelihood that this will take place. In many cases, this score will help identify companies that have significant bankruptcy risk, despite the fact that they've been regular payments or their delinquency score remains high. So now we'll go through the 4 primary scores within a business credit file from Equifax. First off, the credit index measures 7 information elements that could appear in every Equifax business credit report. Each of these 7 elements is measured on a scale from 0 to 10. The higher the score, the higher the risk. When these 7 elements are added, they make the credit index. A brand new company would be assigned a 20 by default. A value under 20 is considered low. A value over 30 is considered high. And in between is fairly moderate. In layman's terms, credit index answers the question, will I get paid? Next, the payment index indicates in which manner a company currently pays its bills, based directly on the trade information within Equifax files. Payment index is calculated on the distribution of total owing across different aging periods. The index is similar to today's beyond terms. A company with an index of 60 would be paying their bills approximately 90 days if that 30-term days was applied. Understandably, 0 in this case is therefore the best, and 90 to 100 is the worst. More important is how often this information happens and how it is trending. If a company is continuously paying their bills slowly, chances that they'll continue to do so is a relatively low risk. However, if they continue to pay slower and slower, the lack of cash flow is likely increasing their credit risk. In layman's terms, the payment index answers the question, when will I get paid? Now into the commercial delinquency score. So the commercial delinquency score predicts the likelihood that a company will pay its bills in a severely delinquent manner over the next 12 months. Severely delinquent firm is classified as one with its payments of 90 days or more past due. The variables in the score include demographic, firmographic, public records, and payment details. It looks to forecast the predictive nature of what's going to happen with this company. And lastly, but not least, the business failure risk score. This predicts the likelihood that a company will cease business, voluntary or involuntary, with the loss of creditors over the next 12 months. Much like the commercial delinquency score, it also takes into account demographic, firmographic, public records, as well as payment details. A hidden insight here is that a business could be steadily and reliably paying their credit, have a nice credit index, and nice payment index scores, but also have a high business failure risk score. In this case, an example might be a business could be operating in an extremely volatile industry, such as upstream oil and gas and present day. Their competitors might be facing very high credit ratings, could be paying their bills late, and this hasn't quite impacted the company that's being profiled. By looking at demographic and firmographic information, it allows you to see kind of what's happening in and around this company, even though its current situation may be that of steady nature. So with that being said, let's look into some scoring scenarios. We'll look into what scores are, what they reveal, and what the possible action could be around the scenarios. So this first scenario, we see that the CI is high, PI is high, but there doesn't seem to be a CDS or BFRS in place. In this scenario, this is where a company has actually gone bankrupt. We don't provide an indication of a CDS variable or a BFRS variable because there isn't one. This business has already failed. In cases such as this, you'll see a note on the file that says the superintendent of bankruptcy has included information on this file, and you'll see the CI score be at an indication of 70. If you look at the profile at the bottom left of the slide, you'll see that what's BFRS history tell us. Over the past few months or a few quarters, you can see that this indication was very high. And this would have been a notification if I was actively monitoring this account that this situation was more likely to occur. The type of action I would take in place if I was just looking at this for origination or adjudication purposes would be to close the account and to make sure that any past debt that I have could be extracted as soon as possible and determine if and when the notice was received. If I had a proactive management process in place, I maybe could have been notified that the payment index or the BFRS score was in a certain situation where I needed to start putting limitations around what I'm doing with a specific account. On to our next scenario. In this scenario, you can see that we have CDS scores, we have a BFRS score. The only thing we don't have is a PI score. So what this actually indicates is we have information on file for this account, but there isn't any trade information that's happened over the past little while. So this is a company that has done business at some point in time, but there's just been no trade information that's been supplied. What this means to me is, if this is an origination process, I really want to take a good look into what this company does. Is this a shell company? Is this a shelf company? Something that's been set up for the purpose of doing business at some point in time? This is something I'm going to be working with. So I really have to ask myself, how much business do we do with this company? How much would we like to grow with this company? And do we submit our own account receivable information into Equifax for this account? If this is something I do business with, I should expect to see something on the file if this is something I'm actually submitting on. On to the next scenario. So with this scenario, again, we see CDS scores, we see BFRS scores, we also see a CI score. But instead of seeing an NA, where PI is, we actually see a score of 0. What that tells us is there is trade information on the file, and this company in particular has good payment history. If you look at the bottom left, we actually look at the history over a series of quarters, and aside from one small blip almost 2 years ago, this company is fairly reliable. This is someone that I would like to do business with. And internally, the action I would like to take on this is to approve something from origination process or adjudication. Cross-sell, I'd want to increase the limits or offer basically as much as I can to this company. We essentially want to make sure that our interactions with this company are positive. And what can we do to make them happy and continue on this path? Can we expand our existing relationship with them in any way? So this is an ideal profile. Yes, their CI looks fairly high, but in terms of paying us, it looks fairly strong. On to the next scenario. Okay, now on to scenario 4. When we look at CDS, BFRS, CI, and PI, we all see an indication there. One thing with this scenario is we do see information that is moving towards the stream of red. So as I look at this, I have an indication that there is something that isn't positive that I need to take a look into. If we look into the PI history, the payment index for this file, it's within that high level. Not less than 20, it's not between 20 and 30. It is technically a high risk. When I look at them over the last few quarters, it has actually been increasing a little bit. And so what I'd actually want to do is take a deeper look into this file. If this was something for an adjudication process where I'm doing business, but I want to take another look at what is my tolerance around it, I might want to consider denying this or at least reducing my limits around operating this company moving forward. Could require deposits and have strict collection efforts in place. So if any time that they go above beyond the net terms that I have in place, I want to make sure that I have active communications with my collections team to be able to control it. So a few questions I might ask myself around this as well is, what risk does our business have about continuing to operate with this company? If they're a supplier, for example, do we have alternatives in place? Do we want to make sure that from a price perspective or a cost perspective that we have a way to mitigate us not working with this company moving forward? Now we'll go into the details of what each score has. What I have up on the screen here is an indication of some of the numbers that feed into these scores, the variables, the controls, and the classification. If we look at the top left, this is a breakdown of the payment index. So it provides how multiple reports feed into the overall score, the size and weighting structure. So if we had three trade lines reporting into a file, one was paid promptly, one was paid net 30, and one was paid net 60, how the overall value of those the credit supplied factors into the total PI score. So it gives you a relative indication about how it actually works. We move over to credit index. When we look at that profile from 0 to 70 and those 7 elements, you can see that the standard distribution of the companies within Equifax's commercial risk database, where they actually stand. So when we look at 0 to 10 and 11 to 20, you can see the majority of businesses fall within that area. Anything above that would make me want to have some risk associated to it. I want to have concerns. I really want to evaluate how I'm operating with those companies if I do have them within my portfolio. For the bottom left, the commercial delinquency score. What this does is provides kind of a class distribution about where those scores fall. In some cases in our reports, we'll provide just a classification, but we also have the ability to give more details into what's actually there. If you take a look at the table, you'll see how the distribution falls, with the majority of companies within Canada falling within the standard business class of 3. Within the business failure risk score, the distribution is very different from our commercial delinquency score. You'll see that the majority of the population falls within risk classification of 1, so that anytime that I'm looking at a company, if I see anything that's 2 or greater, or over under a score of 13, 10, that I want to be able to really evaluate what I'm doing with this business. Even though they might have strong payment terms and strong credit index, I'm really going to want to understand what happens if I don't have access to this business anymore. And now into firmographics and indicators. So with each one of these indications, when we talk about commercial delinquency scores for business failure rating, they all have primary information that feeds into it. Whether it's years in business, looking at a company that's been around for a long period of time has a stronger propensity to still exist in the future. So it tends to be less risky to work with. When we talk about industry, we can look at things like oil patch, where with the cost of oil that's increased over the last few years, there's been a lot of downsizing of these companies and a lot of companies that have actually been going bankrupt. So some tend to be riskier than others, and that's included in some of the profiles for our scores. Regionally, there are unique things at play as well, not only with oil patch specifically for the industry, but having these companies removed from areas within Alberta has forced others who depend on that economy to also follow suit and file bankruptcy or downsize the number of employees. So regionally with Alberta, for example, we see that scenario playing out. Within Quebec, we seem to see a higher rate of delinquency compared to other provinces, and that's a factor that also gets implied into our scores. For companies with a large number of employees, they tend to be less risky, but they also tend to pay their bills late. This is something such as major retailers, where they have a corner on the market, or they have a large number of suppliers. They essentially can dictate when they pay back certain companies, and it's at their own discretion. So even though you may see payment terms stretch for these larger suppliers, they still will be able to pay. They just tend to pay a bit later. And same with annual sales. Companies that have a higher annual sales volume tend to be less risky to deal with as well. They have control over the number of employees. They can basically downsize or reduce what they're doing, but they still have a higher number of accounts and funds coming into their company, so they still can control what they're doing. And that takes us to the bottom line. Essentially what we wanted to talk about in this webcast is understanding some of the hidden insights, and these really fall into 3 primary areas. One is an internal assessment, understanding what insights that scores provide to help you understand what your current portfolio does. The second is a general risk assessment and adjustment. Once you have an understanding about what your current portfolio has, it'll allow you to set your risk tolerance levels for origination and adjudication decisions. And the third is proactive management. Once you understand these risk tolerance measures, you can then set triggers and have proactive alerts in place to eliminate or reduce write-off before they even occur. Thank you for choosing Equifax as your trusted credit bureau. If you have any questions, we're always here to help.